if it's something, if your thesis is right that inflation is coming, then that's almost cataclysmic and game changing, isn't it? So for the last 30, 40 years, we've had a deflationary economy and a deflationary ecosystem. And, the dollar has been holding strong. The bond markets have been holding strong. You've had low interest rates. And, all of that has meant that the asset portfolios behaved in a particular way. Lots of leverage happened in the system and so on and so forth. If what you're saying is right, and if inflation is not just transitory, but it is going to be, a little bit more long term, that is going to sort of upset a lot of apple carts here, isn't it? What do you think? It seems to me that we are headed towards Armageddon almost. What are your thoughts on that?
Well, you're right. We've had 40 years of a slowing rate of change in inflation. And I want to be clear that I'm not calling for very high inflation. I'm not calling for levels that we saw in the 1970s. The point I'm trying to make is that higher inflation can cause serious problems because the level of interest rates is so low in reflecting that high inflation. So yeah, it's potentially game changing. So here you have, on one hand, you have central banks that are telling you, we want higher inflation, right? That's what they say. They've created this arbitrary 2% inflation rate. And I want to be clear, I used to work for Larry Lindsey, who was a Federal Reserve governor in the 1990s and was George W. Bush's senior economic advisor when he was president. And there is no economic basis for saying 2% inflation is the right level of inflation. The only reason why there is a 2% inflation target is because theoretically, if that actually happens, that assumes that the Fed funds rate, or the short-term borrowing rate, would be at or above 2%. Therefore, in the next economic downturn, the Fed would have rates to cut to respond to that. So it's now become, unfortunately, a religion of central bankers to get to 2% inflation. But now that we're actually going to be there and higher, central bankers are already saying, well, it's just transitory, it's just transitory. So it almost makes it unclear exactly what they want. But it's one of those things that, and I've said this for years, is that the central bankers better be careful of what they wish for. Because here what they've done is they've created the biggest bubble in the history of financial markets with what they've done with global bonds, particularly Europe, with negative interest rates. I mean, there's still 12 or $13 trillion of bonds with negative yielding securities. That's the epitome of a bubble. So here they've created the biggest bubble ever, and then they root for the exact thing, inflation, that would pop that bubble. Doesn't make any sense. But now we have the inflation, and it'll be really interesting to see how central banks respond to that. Unfortunately, though, to your question, is that there's no painless way out of this. There's no free lunch. And the right thing to do if you're a central banker is to stamp out this inflation, even if it means correction in the markets, even if it means hiccups in the economy, because low inflation is the precursor and foundation of stronger growth. You'll never get healthy growth if you have sticky high inflation. So it's this gets to my point that the next couple of years are going to be quite different than the prior couple of years. And putting aside the tragedy with COVID.